Well, all right, here we are. So I'm going to open up the calendar real fast. Oops. Oh, that's not what okay. So there's March. Now, this is today's the 25th. So I mean, basically the month is over, but in next week, Tuesday is the first. So let's get an April calendar. Mm. A nice big one, that is. Here we go. All right. So now remember last week we had a bit of a snafu because I forgot that there was supposed to be another online class. Um, it does apparently say, I have to go confirm it, already in the schedule that the third and final in-person class is supposed to be on the 29th. So let me just confirm that real fast. And because what we have to do is pick another one. We do have to meet 3 times in person. I'm not positive why, but we do. And so I'm just going to look at this for a second. Yeah. All right. So, oh God, I already forgot what room we were in. It's 135. That's one that has the green board there. So, yeah, I think we may as well knock it off next week. Does that sound okay? I'm not sure. I mean, it's Tuesday. I mean, what do you normally do on Tuesday nights? But, I would remind you multiple times that, that's the night that you should be there in person. And then that way, of course, we were supposed to do it last week, but we, kind of forgot about it. So this way we would satisfy the requirement of having 3 in-class meetings. The third and final one could be the 29th. So unless somebody has a really serious objection, I'm going to write down here on my calendar that we would like to have our second meeting in person on April the 1st, a week from tonight. All right, so let me just write that down, and I'll send out announcements, um, so everybody knows. So it'll be the first will be the second meeting, room 135, and then the last one will be the 29th, the last in-person meeting, that is. All right, so I think that was the only piece of business we had to attend to here. And when other people sign in, I'll remind them. So we'll do the first and the 29th, and that'll satisfy that requirement. After that, I haven't even looked ahead that far. Now it's Oh, by the way, I did write here's our other announcement. I did write the midterm, but I was having a technical issue with it, and I'm not sure if Cengage got back to me yet. So I'll when we're done, I'll look and see if I've gotten any emails from them. It's all ready to go, but there's something preventing it from getting attached to the rest of our existing assignments. So I will investigate that very quickly. Now, once they've fixed that, I'll choose a due date. It'll be, at least a couple of weeks ahead of later than when it actually becomes available to you. I want to make sure you have plenty of time to finish it. And it's also not it's not overwhelmingly difficult. It's really, in fact, it's got a lot of multiple choice questions, as a matter of fact. So yes, you'll have to do some calculations, but it's not going to be like quite as involved maybe as some of the existing assignments. So um, I'll be investigating this for the due date. Once they get me are enabled to let me get it onto the Brightspace, then I'll set a due date for, let's say, 2 weeks after that or so. And then I'll make an announcement that it's ready and you can go ahead and start at any time. And then the final exam actually was already in there. I forgot all about that. I left it there from another semester. So I think some people have already started working on it. So that's kind of helpful. So the final exam is already online. That would be due right around the time whenever we would have had it in the classroom. I'd have to look that up in their academic calendar, but I think it's like maybe the first full week of May, something like that. So now, of course, this was always meant to be an online class, so there was never any time, any intention that we have an in-class final exam, but there's going to be some hard cutoff date for the grades, and that's what I have to keep an eye on because um, if they say it's due on, let's say, May 5th, they mean May 5th, and they don't mean just in the evening, they mean around noon sometimes. So I would have to figure out the right due date to make that work. So we'll get back to that later on. And also, don't forget, there's a paper coming up. I mean, it's one of those things you ideally should have been working on already, but remember, there's a requirement for a short paper, like 8 to 10 pages. And it can be on any topic that's relevant to this class, basically. Anything to do with exchange rates, to do with, let's say, the gold standard, the Federal Reserve System monetary policy, the creation of the euro, the Bretton Woods system. There's a lot of things you could potentially write about, all kinds of possibilities. You could even talk about like some of the new members of the Eurozone. There's a lot of things that could potentially be done. And, all this information should be readily available on the internet. Not that you can't go find actual books, but if you look at sources like, let's say, for example, the Economist magazine, you'll find a lot of very useful information about exchange rates. Or there's others like, let's say, the Financial Times of London. Typically I find that European newspapers and magazines, or British in particular, tend to have a lot more information about exchange rates because in Europe, their GDPs are trade is a much larger percentage of their GDPs than in the United States. So there's more attention given to it because it impacts them directly. Whereas here, it's hard to say when, is the dollar really affecting our daily lives? It's hard to be sure, but in Europe, even small changes in the value of the euro or the pound can actually have a pretty significant impact on their economies. So they do tend to spend a lot more time with writing about these issues. So the Financial Times London might be a good source. The other problem is it's getting to the point where you have to really pay for everything online. That's kind of frustrating. The Wall Street Journal might have some, but yeah. So I think the Economist would be good, but I'm afraid that you may have to pay for it. So, but they definitely would have a lot of excellent articles about exchange rates. Oh no, I was afraid of that. Yeah, look at that. It wouldn't even show me the article. But you never know what you can find. Maybe not all the articles. Like there's one, but you should be able to find what you need. It shouldn't be difficult at all. These topics are written about very extensively every day in the financial press, so I don't think you'll have any problems finding what you need. All right. So other than that, I think we'll just keep going with our discussion about chapter 8, which is our look at long-term factors that affect exchange rates. Okay. So in the short run, we assume that exchange rates are heavily driven by interest rates because in the short run, we're assuming that investors are primarily investing in foreign currencies for the purpose of increasing their rate of return compared to their own countries. Okay, so in other words, if I'm an American investor and I see that the euro sterling rate is going up, I might decide to shift some of my funds from euro dollars into euro sterling, and that would be my main motivation. Okay, but in the long run, our motivations are very different. Oops, hold on. So, in the short run, we assume that the demand for foreign currencies is heavily driven by interest rate differentials. Countries with relatively high interest rates. Now, by the way, I just want to mention one thing here. When I say countries, I mean you're looking here at the major European countries, Japan, Canada, Australia, New Zealand, not smaller countries where there may be a lot of, let's say, political risk, or there may be a ton of inflation or other problems potentially. We're looking at the largest countries where they're very safe. Investors feel free to keep their funds in those countries. When you start looking at other areas where maybe there is some political risk, where maybe governments get overthrown every so often, where there's a lot of inflation, those countries are a little bit different because then investors may be reluctant to hold those currencies. And so the demand for those currencies is going to be a little bit different. That's really more for people who are specialists in those areas, who are willing to take on a lot of risks. So, but countries like, let's say, England and France and Canada and Germany and major uh, major economic powers, I guess we'll call them, um, among those, you'll see that when interest rates go up, their currencies tend to appreciate. So countries with relatively high interest rates tend to have strong currencies because this attracts what are called capital inflows. In other words, investment funds. So in other words, investors might say, well, US rates are going up. Maybe we should hold euro dollars rather than what we're holding now. Okay. In the short run, inflation, it doesn't change a whole lot in the short run. It is what it is. The inflation differentials are whatever they are, and you don't see them change over short periods of time. But interest rates can fluctuate quite dramatically over short periods of time. So if I see that, the British have just raised interest rates, I might be tempted to pour some of my money into Great Britain and take advantage of the higher interest rate differential. Okay. So that's a short run. So in the short run, in other words, investors see currencies as financial assets for the most part, not exclusively, of course, but that's their primary motivation for holding them. Okay, but in the long run, we assume that the demand for foreign currencies is based on the actual consumption of foreign goods and services. In other words, in the long run, what can you do with a foreign currency? You can spend it. That's about it. I mean, in the short run, we're trying to earn a high rate of return, but in the long run, we actually want to acquire foreign goods and services. It's like when you save for your retirement. Um, you keep saving and you keep investing in it, et cetera, but at some point there comes a day when you really need to spend it because that's the whole point, that you have money to live on. So suddenly now your focus is more on maximizing the value of your purchases rather than the return on your investments. Okay, so the same thing is happening here. So this means the countries with the most attractive goods and services, let's say, tend to have the strongest currencies. So if people want to buy American products, that's going to keep the dollar strong, right? Everybody around the world wants an iPhone, for example. If American products are in hot demand, that will tend to keep the dollar strong because people will have to buy dollars to acquire those products. This also means, though, countries with higher inflation rates will tend to have weaker currencies because that affects the purchasing power of foreign consumers, as well as domestic, of course. Okay, so in other words, there's some countries that consistently have relatively high inflation rates year in and year out, and they're going to definitely have weaker currencies as a result. Some South American countries have had a lot of experience with inflation, and that's definitely going to harm their currencies. It depends on what country it is too. Like Ecuador, I think we discussed this. Ecuador, when they decided to dollarize, their inflation rate was thousands of percent. It was a lot. So, they realized they had to do something about it. And so that's one of the reasons why they dollarized, because their inflation rate was so out of control. And they didn't see any other way to bring it down. So up to this point, we've been primarily focused on the short run behavior of exchange rates. Now we're going to focus more of our attention on the long run, when the actual purchasing power of a currency is what people are really interested in, as opposed to the rate of return. Okay, so the purchasing power of a currency is a huge long-term determinant of its value. As opposed to the rate of return, which um, you're seeing more of that in the short run. Okay, so now these theories that we're about to look at, these are not based on arbitrage. Remember, we talked about arbitrage, um, where you have the opportunity to earn risk-free rates, risk-free profits by exploiting mispricings in different markets. So the long run theories of exchange rate determination are not based on arbitrage considerations. Okay, because there's really no way of taking advantage of this. For example, if we discover that, let's say, butter is consistently more expensive in the UK than in the US, they're more expensive in the UK than in the US, there is no realistic way to earn profits from this situation. And so, because of that, this means the price discrepancies can persist for long periods of time. And that means years or even decades. Okay. So, we're saying, well, if we had different prices. Now, gold is different. By the way, we talked about gold once before. Gold is really a financial asset when you come right down to it. Butter is very different. Butter is a commodity. It's something that it's perishable. It's inexpensive. It's not realistic that we can imagine shipping butter back and forth across the ocean to take advantage of pricing discrepancies. But we could do that with gold. Okay, but gold is a very different situation, because it really, for all practical purposes, is an investment asset, although it does have its own industrial uses as well. But for consumer goods and services, you're not going to find it's possible typically to earn profits from taking advantage of mispricings, certainly not risk-free like is required for an arbitrage. And again, like, remember, we talked about the triangular arbitrage, when the spot exchange rates are inconsistent with cross exchange rates, then we can make trades and put money in our pocket without it taking very long or costing a lot of money. In fact, it can happen instantaneously if a computer is executing trades over a computer, or through the internet, I mean. So, but here it's a completely different situation. So this means that prices in two different countries are not necessarily equal. And especially, and over time, um, the probability of different prices in different countries is actually increasing, since there are, for example, restrictions on trade, um, ex costly transportation or transportation costs, I should say. And also another consideration you don't run into with financial assets, quality differences. What if it turns out that British butter is different than American butter? Maybe they use different fat content, for example. In fact, one of the reasons I chose this example is because I know for a fact that European butter typically has a higher fat content than American butter. Especially, there's one brand that I know, it's called Kerrygold. It's an Irish butter, and you can buy that in the United States. But if you're going to cook with it, be aware that it does have a higher fat content. But it tastes amazing as a result. But in other words, you wouldn't directly compare, let's say, Land O'Lakes with Kerrygold to determine if prices are the same in, let's say, the United States and Ireland. So these theories, and plus, by the way, these theories that we're about to look at have been around for a long time for the most part, and they're not, it's interesting to know about them, but it's hard to see them as a complete theory of exchange rate determination. Because the conditions under which they were developed are very different than they are now. So now we did introduce this concept of purchasing power parity. I don't know the exact year, if there's even a person who's credited with inventing purchasing power parity. Oh, they think it came from the Swedish economist Gustav Cassel. Huh? That's very possible, but oh no, in the sixth, sorry, it originated in the 16th century and it was developed by the economist Gustav Cassel. I think he may be a Nobel Prize winner, but as you're pointing out here, the whole thing is based on the so-called law of one price, which means that the same goods should sell for the same price in two different markets once we take into account the exchange rate. Now, of course, this assumes a lot. You're assuming away the existence of trade barriers like tariffs and quotas, transactions costs, the actual cost of shipping goods back and forth between countries. So another issue with this purchasing power parity idea is that a lot of products in the marketplace are not actually traded between countries. Like I said, with the butter here, if you had a price discrepancy in butter, it's not going to be worth our while to try to ship it back and forth between the two countries. So that kind of thing could be defined as a non-traded good, meaning it's too inexpensive to make it worth our while to try to engage in goods arbitrage. So yeah, the whole idea here is this is based on the law of one price, which implies or states hold on a second. That yes, like we said, that the price of a good should be the same in every country after taking into account the exchange rate. Oops, running out of space, the exchange rate. All right. Now, of course, we know that that's not going to be true for a lot of goods. So absolute PPP is basically saying that the law of one price holds for all goods. Okay. And of course, we know that that's not true. So naturally enough, the law of one price, I mean, the PPP itself is going to be very fatally flawed. Now, interestingly enough, the Economist magazine actually published a very famous article about this quite a few years ago now. And what they decided to do is try this. Let me just mention this. This is kind of interesting. And I think we can get articles on the internet for free from The Economist about this. The Economist magazine once published an article about the law of one price, and they decided to use, believe it or not, the Big Mac to test whether the law of one price holds throughout the world. So they basically went out and they priced the Big Mac in all the major cities throughout the world. So they got data for, New York, they got for Canada, they got maybe Toronto, um, they went to Australia, they went all over the place, and they basically found out how much does it cost to buy a Big Mac in the local currency, and then they compare that to the price in the United States in dollars. The theory being that it should be the same. So, for example, if the exchange rate between the dollar and the pound is $1.50 per pound, and let's say a Big Mac costs $4 in the US. Actually, let's make that 4.50 to make it simpler. Then the implied price in Britain or in the UK would be 4.50 over $1.50 per pound equals $3 per pound. Okay. So in other words, if the law of one price is right, according to this theory, then you should expect to see sorry, I did this. This should say three. I made it. I read it wrong. Sorry. Um, it's 4.50 per Mac, and that is then divided by $1.50 per pound. Yes, now we're getting somewhere. And that there you go. I had it wrong here. That implies £3 per Big Mac. That's better. Okay. So I mean, if it's $1.50 a pound for the exchange rate, and the Big Mac is selling for 4.50 in the US, then according to the law of one price, then it should take £3 to buy a single Big Mac in London or in the UK. All right. Well, now you might think, well, okay, that's interesting. Clearly, Big Macs would be considered to be a non-traded good, meaning they are perishable and the cost of shipping them between countries to take advantage of pricing discrepancies would be prohibited, of course. So you probably figure this is not going to work out too well, and you're right. It does not work out too well. So I'll tell you what, we should be able to find the latest numbers for this. They do this every year, by the way. Once it caught on, once they wrote this article, everyone thought it was so interesting that they agreed to do it every year. So actually, this is not coming from The Economist, but what this is showing us is if you once you take into account the exchange rate, how much it actually costs to buy a Big Mac in these different countries. So the United States, let's see, where do they have the US? It says here about 5.15. All right, so they're going with a price of 5.15. So what they're saying is that in Switzerland, you're actually paying the equivalent of 807. Okay. Uruguay to 707, et cetera, et cetera. So in these countries, um, their currency is not buying enough dollars, according to this theory, because otherwise it should be the same, which means that it's undervalued against the dollar. Down here in these countries, it's cheaper, and that means these currencies are overvalued against the dollar. And so yeah, they've got a nice graphic. I've never seen this before, this particular one. They've got the dark blue is the really expensive Big Macs. Then the blue sort of gradually shrinks. Oh, here it's 569, 552, a little cheaper. Some of these South American countries is a little cheaper, Australia, but then yeah, like here in the Scandinavian countries, Norway and Sweden, it's quite expensive. China 353, India. So in other words, but what you're not, if the law of one price really held, every one of these would be $4, the same as the United States, 569. So you can see in many cases they're not even close. Look at these percentage differences. Okay. So those numbers tell me, yeah, and they're all quite, no, look at that. This Taiwan is off by, look at that. You can get a Big Mac for the equivalent of 228 in Taiwan. Okay. So that is the kind of thing, but I mean, it shows us that PPP itself isn't likely to hold if it doesn't hold for these individual goods and services. Okay. So I thought you'd find that interesting. But the Big Mac Index does, it illustrates what the law of one price is actually trying to say, but it also illustrates how it doesn't hold, at least not for Big Macs. Now, if they chose a different good, they might have found that there's fewer discrepancies, but it's not likely that these numbers would match for any good. Part of the reason is because there's too many differentials. We're assuming here too that the Big Macs are identical in all these countries, and even that might necessarily be true because every McDonald's is every country is a little bit different. For example, the ingredients might be different, the way it's put together might be different. So it's tricky business to try to compare them directly to each other. But anyway, so this is a sense of what the law of one price is all about. And um, so that what does that say about PPP? Now, we might be able to also find an article explaining how well PPP holds. Somebody would have done some hardcore research. I'm sure somebody has, but we want to avoid any papers that are horribly technical. All right, well, here's the St. Louis Fed. We can rely on them. Okay, I'm not quite sure what they're showing. So yeah, we might as well lean on there's some of their definitions. Most models in international macroeconomics assume that PPP holds in the long run, but what is it and what is the long run? Well, a good starting point is the long run price, which means that the same good in different countries sells for the same price. Now, if they're in the same country, by the way, we have to take into account, or we have to essentially assume away the transportation costs and barriers. Now, why is that, by the way? Because let's say you imagine you had two neighboring countries with different prices for eggs. People would just go across the border and buy the eggs in the cheaper country, and then they might come back and sell them in the more expensive country, and the prices would even out. So it would be more like an arbitrage. Um, Now here they're telling us that PPP is usually not measured in terms of a single good, but what we call a basket of goods. Okay, so let me just take a detour here and remind you what that's all about. So I just want to take a little bit of a detour here. In the United States, one of the major ways that we measure inflation. As you may have heard of it, the Consumer Price Index. The Consumer Price Index um, attempts to measure cost of living for what they call typical urban household of four. So in other words, what they actually do is the Bureau of Labor Statistics, which sponsors this, BLS, um, gathers data for over 8,000 different consumer goods and services in order to construct the CPI. The proportions of the goods, the basket, known as their weights, are determined by historical experience. In other words, they survey people. They'll listen. What do you buy during a typical year? Like, and they'll say, well, we buy chicken and we buy fish and we buy tires for our cars and we buy gas and we buy furniture for the house. And so they do all this research and they try to find out what exactly a normal family buys during the year, not just the items themselves, but what proportions they're spending on them. And then they go out and calculate prices from local stores and they come up with a single number which indicates the overall cost of living in the United States. Now, at the moment, the CPI is something like 200. Well, let's find out. Let's just guess. Um, Here are the Bureau of Labor Statistics. Now, let's see. Now that number, by the way, that number is simply the percentage change. It went up 2.2% since January, which means a 0.2% increase in overall prices. But the CPI itself is an actual index. And oh boy, I always find this website to be very awkward to deal with. And they'll explain in great detail everything that they've done to get to these points. Tables, that's probably better. Oh my God. Yeah, but you see, I want the index. You see, like I said, I've always found this to be extremely awkward. Um, if I type CPI, it's not going to understand what I want. Ah, okay, let's try that. All right, it says here 378. What does that mean? Well, oh, here we go. We got an Excel spreadsheet. And if it would let me have it. Oh, there it is. All right, it's gonna be stubborn. I can tell. Yeah, I think we better give up on this. All right, what matters is that it's 373 right now. So, like I said, every time I go to this website, I have the same experience. It's kind of a nightmare, but you can see if you scroll down, it's only going back to 2024. The basic logic behind this is that it goes back to the early 80s, where the base year was chosen, and that was set at that time it was set equal to 100. Okay. So the base year, the CPI is 1982. At that time, CPI was set equal to 100. In 2025, it is at 373. So that means that prices have risen or 3.73 times what they were in 1982. That so this works out to an annual inflation rate. All right, let me get out my calculator and tell you what that is. It's about 3.1%. Okay. Now that's an average. Obviously there were some good years and bad years in there, but 3.1% isn't terrible in this day and age. The Fed's target is around 2%, just as a point of comparison. But a lot of that happened in the last 4 years. So it's a little deceiving. Before it was quite a bit lower than that. But anyway, so the purpose of all this is to show that this number, this 3.1%, um, could be thought of as US inflation rate. And so in the UK, um, inflation is computed with the retail price index, known as the RPI. It's done in a very similar way. It is also based on a basket of goods consumed by a typical family during the year. So the inflation rate derived from the RPI and the CPI are used in the PPP theory to determine the exchange rate between the dollar and the pound. In other words, according to PPP, the nominal exchange rate, meaning not adjusted for inflation, should reflect the CPI and RPI in the US and UK, respectively. Okay, so in other words, the absolute PPP claims that the strength of the currency depends on purchasing power of that currency. Okay, relative to another country, of course. All right, so that's what really this PPP thing is all about. It's all about prices and purchasing power. The countries with where the goods are the most affordable, let's say, are going to have the strongest currencies because people will want to buy those products. If American products are cheaper than British products, people will buy American products instead, and then the dollar will get stronger. Otherwise, if it's the other way around, then the dollar will get weaker. All right. Anyways, that's kind of in a nut in the essence of PPP. Now, there's two versions of it. The first one, the absolute PPP, is the really rigid one. The second one, the relative PPP, is a little bit more down to earth because they're trying to express not so much the levels of exchange rates, but the percentage changes in their purchasing or their value over time in terms of inflation rates. Now, the formulas that the book uses are here. Now, this is the actual formula. This is the approximation that they might let you use this in MindTap. I'm not sure how they're going to do that, but what they're showing you here is this. Okay. So you've got EF is the exchange rate. I don't know what the F stands for, but oh my God. What is that? All right. So they're using the symbol EF for the exchange rate. What what is this supposed to be? So that's the exchange rate. Now, whether it's dollars per pound or pounds per dollar does depend on um, how this thing is written. So I'm going to assume that we're talking about dollars per pound. And so they're expressing it as the ratio of 1 plus H, not H, IH. Yeah, IH. Over, now H means home, by the way, home country. So IH is the inflation rate. Capital I in this book is inflation. So that's the domestic or home inflation rate. And then the IF, of course, would be the foreign. Well, foreign, it's inflation rate. All right, let's make up a quick example here. Man, I don't know what to do about that. It's throwing all this crap in here. All right, let's just quickly make up some numbers. Let's say that EF is what we're solving for. Actually, I just realized they've written this very badly. That EF is not the exchange rate, it's the percentage change in the exchange rate. They really should be more clear about that. So, all right, let's try that again. So let's just say that at the moment, the exchange rate between the dollar and the pound is, let's say, $1.50. And then we discovered that the US inflation rate is 3%. And in the Britain, it's 5%. So the theory tells us that the dollar should get stronger, meaning that that exchange rate should drop. So according to the theory, if I put EF again, percentage change in E is 1 plus IH over 1 plus IF minus 1, 1.03 over 1.05 minus 1 equals it's negative 0.019, which means the dollar should appreciate by 1.9% over the coming year. And if it does, the new amount would be wait, no, that's not right. Sorry. So if I divide that 50 by 1.019, that means it should be hold on. It's about $1.47.2, let's say. Okay. So that's what it's predicting. It's saying, listen, both currencies, the purchasing power is going down, but the dollars is less than the pound. So therefore, in relative terms, the dollar should get stronger against the pound. And that's what we predict it'll be. Now, research has shown, by the way, this is the simpler version. They may ask you to do this in MindTap, where you just literally just subtract one from the other. It's not quite as accurate, but it's pretty close. And so empirical research has shown that this version of the theory actually does work reasonably well. In other words, if you're only thinking in terms of inflation rates, it actually does reasonably well, whereas the absolute levels, it doesn't really work very well. So here they're trying to explain to you why this is happening. Relatively high inflation means that exports will increase because people are buying more foreign products. Our exports will decrease because foreigners will avoid our products. And so our trade balance will get worse and our currency should depreciate. Okay. But if this is the other way around, if inflation is relatively low at home versus abroad, we'll buy less foreign goods. Foreigners will buy more of our goods and our currency should appreciate. In the third case, they're both so similar that there's no change in the value of the exchange rate. Yeah, so now, they're trying to illustrate some research that has been done. This line shows you all the different points between, in the new vertical axis, we have the inflation differential, and on the horizontal axis, we have the percentage change. So in other words, in our case, where IH minus F rather was minus 2%. That would put us down here. That means that we should expect the dollar to gain. Now, negative in this context means gain. We're gaining 2% against the pound. Now, what they are showing us, though, is that if you're going to do actual research, you're going to have a large number of results that aren't going to look like this straight line. They're going to be a lot of, let's see, I think they have yeah, here it is. This is the kind of thing you'd expect to see because, oh my God, I lost it. I was hoping to make it a little bigger so you could really see it. There you go. So each one of these dots represents a single year's observation on the difference between American and Canadian inflation and the percentage change in the US dollar Canadian dollar exchange rate. So all these dots represent actual data. You would use regression analysis to try to connect them. You would draw a line through these points that hopefully captures them as well as possible. And you ideally want this line to have a slope of 1. Okay, in other words, if the theory is perfect, then these should exactly match each other. To the extent that they don't, that means that PPP does not hold. Okay, you can see the discrepancies are greater for some currencies than others. It doesn't appear that it holds in any of these cases. Not really, because that would require a slope of 1. So what you're actually doing is comparing the slopes of these trend lines to 1 to see if PPP actually holds. Okay. So yeah, I mean, what do you expect? I mean, come on, PPP is based on a lot of very strong assumptions that are almost certainly not true in practice. And they're explaining now, of course, as I started to say this and I got sidetracked. The reason why these points themselves are not even on this line, not not all of them at least. Let's look over here at the Swiss franc and the dollar. Um, oops. All right. The reason why these points are not on this line is because other factors besides the inflation rate are affecting the exchange rate between the dollar and Swiss franc in this case. So, these types of graphs are based on the assumption that there's only one dependent and one independent variable. If that's not true, then these actual points will not be right on the line. And so, of course, other factors besides inflation do affect the relative strength of two currencies. So you don't expect these points to be right on the line, but what we were hoping to find is that the line itself at least has a slope of 1. And you can see that's not really the case. Oh, well, tons of research is done in this area. You wouldn't think so. You think everyone would have concluded a long time ago, it just doesn't work. But people keep studying this all the time. What they're probably trying to do is come up with an improved version of this model. Like they might think that if only I could come up with another factor that when combined with inflation really does explain exchange rates, then they could be famous, which is what academics are after. They're not after money, they're after fame. Okay. Now, of course, the tests have issues, and they're trying to explain some of the other factors that might potentially be responsible for the exchange rate behavior that we're seeing. Inflation would only be one part of it. Look at all these other ones. Changes in the interest rate differential between two countries, incomes, which means GDP, government controls, which means tariffs and quotas, expectations. So a lot of other factors can potentially determine an exchange rate besides simply inflation. All right. So, there's a lot of problems with the theory. Like I said, the law of one price is assumed to hold. It certainly does not necessarily for every good, as we saw for the Big Mac. Um, there could be, for example, tariffs and quotas that are forcing it to prices to deviate from what it claims here. There could be changes in other variables. There could be a lot of reasons, but one of the reasons is because simply when goods are not priced the same in different countries, there's no way of taking advantage of it for the most part. Now, along comes Irving Fisher. Now, this is a new theory, by the way. That was all purchasing power parity. This is now the international Fisher effect. So Fisher, well, pretty famous figure in the history of American economics because let's go look him up real fast. Irving Fisher. Now he kind of lived right after he was born right after the Civil War, lived right, let's say past World War II. He was known for a lot of things, but he was an economist, statistician, um, not maybe as famous as some of the other economists at the time, but he wrote a lot of important works. But he also was one of the pioneers of developing this index numbers, which led to the development of indices like the CPI. And he also, now believe it or not, this man was kind of very multi-talented individual. He got the first PhD ever granted by Yale University in the economics department. But he also was an inventor. Yeah, there it is. And he invented this very interesting device. I'm going to show you one and see if you've ever seen one before. What is that thing? This is called a Rolodex. Now, you can ask your grandparents if they used one in the office. Basically, it has these little index cards and designed to let you roll through them very quickly and add or subtract them. In other words, you can see while they have these what are they called? Rings. You can easily take these cards out or put more in. They're designed to be easy to remove and to put back. So imagine yourself writing down all the names and addresses of your friends, and this is where you would keep them. Or recipe cards, for example, this is where you'd keep them. So before computers came along, this is how people kept track of their information. And the reason why it's so popular is because you can see how easy it is to roll it through and quickly get to the card that you're looking for. So he invented this thing. So he made a lot of money from his invention, but he also was an academic. So he had the leisure to write books about the economy. But what he really became famous for was his theory of interest rates, which he wrote in his book, The Theory of Interest. Um, so the bottom line is he explained the relationship between real and nominal interest rates. Now, nominal interest rates are the ones we observe in the marketplace. The ones you see, you go to the bank, you're seeing the nominal rates of interest. Real interest rates are the ones that are adjusted for inflation. So his theory actually is relatively simple. He's basically claiming that if you take the nominal rate of interest, let me sneak this in here somewhere. So the Fisher effect, as it's called, yeah. So no, he's a very, very important guy. The Fisher effect, which applies only to the domestic market, by the way, shows that the nominal rate of interest equals, actually, this can be written in different ways. The real rate of interest, let's put it this way, equals the nominal rate of interest minus expected inflation. Okay, that was like, now keep in mind, this is the 1920s. A lot of research has not really been done yet in economics. You figure this is like common sense, but not, no, no, no. It took a long time. In fact, the whole idea of business cycles wasn't even thought of until the 1930s. That's when it started being studied seriously. The concept of business cycles. It took a while for people to come up with that idea. And the fact, so in other words, in the 19th century, people were not saying words like recession and recovery and depression because those ideas weren't really written about. That came much later. So here's what he's saying. Now, this is then being extended to the international sector. And by the way, they're mentioning here that the real rate of interest is the return to investors after accounting for inflation. In other words, what they're saying here is that it represents the increase in purchasing power from an investment. So in other words, if I go to the bank, um, here we go. So here, yeah, here's an example. 8% is observed or nominal. Real is 3, 5% is inflation. This means that if I put my money in this bank, my bank balance goes up 8%, but my purchasing power goes up by 3. This is the increase in purchasing power. This is the increase in my bank account. And you can see that's not the important one, is it? No. So now you're saying, well, what does this have to do with exchange rates? Well, what they're going to do here is say, well, listen, um, in a nutshell, what they're going to do is this. Let me just take a sidestep here. The international Fisher effect shows that um, the interest rate differential between two countries matches the inflation differential, assuming that real rates are the same in all countries. Now, that's a very strong assumption, but it's not as terrible as it sounds because real rates of interest reflect factors such as productivity, the national savings rate, etc. So if we can make that assumption, just imagine that we've got saying, all right, let me use their notation. Here's country A, and the nominal rate well, actually, if I rearrange the Fisher effect algebraically, let me go back for a second. Okay, I just want to mention that algebraically, this implies the nominal rate of interest equals the real rate of interest plus the expected inflation. All right, I just want to mention that because I want to do something with it right now. So that implies that nominal equals real plus inflation. So then we have country B, its nominal rate. Here, I'll call it nominal rate B. If these are equal to each other and I subtract one from the other, then I'm going to be left with nominal rate A minus nominal rate B equals inflation A minus inflation rate B. All right, so therefore, if country A has higher nominal rates than country B, it must also have a higher inflation rate than country B. Therefore, in the long run, the countries with the highest interest rates will actually have the weakest currencies, as opposed to the short run where it's the other way around. Because in the long run, we're attributing that higher inflation, interest rate rather, to higher inflation. In the short run, we're holding inflation constant, basically. We're assuming that in the short run, prices are fixed. There's not enough time for them to adjust. Right. So in other words, it's a good thing when the country's interest rates go up. Okay. So in other words, in the short run, prices are assumed to be fixed. In other words, there's not enough time for them to change. So inflation is fixed, and an increase in a country's nominal rate of interest oops, translates into a higher real rate of interest. And therefore, as capital flows into that country, its currency appreciates. But in the long run, the higher interest rate is assumed to be attributable to higher inflation. Okay, so that is actually detrimental. So this is one of those cases where the same factor can have the opposite impact on the currency in the short run than the long run. Now, of course, it's hard to say what the long run is. It could be a couple of years, it could be a couple of decades. That's often the case with economic theories. The idea of long and short run is interesting, but it's rare that they can specify how long that happens to be. But you can imagine that for over a few months, the inflation rate is not going to change very much in, let's say, the United States and England. So if interest rates, like the Fed raises rates, at least for a while, the US will have higher real rates than in the UK. And that will attract capital into the US, which will in turn strengthen the dollar. In the long run, higher interest rates would be seen as a bad sign, and so people would avoid that currency. And so that is our friend, the international Fisher effect. The other one was just called the Fisher effect. This one is the international version. Let's see. Okay, that's what we were just saying. Let's see, what are they trying to do here? You've got three countries, three one-year nominal rates. We're assuming that savers require an increase in purchasing power of 2% to hold funds in that country. So that's 2%. So that means, as you can see, inflation rates will be very different here. So in this column, they're comparing the interest rates on the savings accounts for the three different countries. The inflation differential, what have they done here? Not positive how they figured these numbers out, but all right. Anyway, um, and they're gonna try to do the same thing here. They're gonna have a line. This is regression analysis. This is how you estimate it. This is where these relationships would hold. You notice how again it's got a slope of one. All right, so here's what they're doing. They're saying now, remember, with the interest rate parity, though, the differential in interest rates is largely responsible for the difference between the spot and the forward exchange rate. Once you also take into account the current spot exchange rate, but the Fisher effect simply says that the interest rate differential between countries is driving the inflation differential, and expectations are coming from PPP. So the one on the top, of course, is the arbitrage-free relationship. This one has to hold to avoid arbitrage opportunities. These two could be violated for many years at a time. So these are considered to be long-run effects. Let's see. Then they summarize all this good stuff. All right. Well, I'll tell you what. It looks like we're ready to start chapter 9 now. But I'll tell you what. Why don't we have our break first? Let's see. Why don't we come back at, let's say, 5 of 9? That should be enough time to get something to nibble on. And then we'll at least take a quick peek at chapter 9. Right? Now, remember, too, I'll remind you many, many times, next week we're going to meet in person. So, let's see. Hold on. Why don't I can't seem to find Blackboard, or a bright space rather. I've noticed that happened to me before. It disappears if you're not careful with it. Let me just open it up for a second. Forecast. Okay. Now this is a little bit different. Um, this one, I think if I remember correctly, this one involves regression analysis. For God's sake. That's good because we can easily do that in Microsoft Excel. So there's a lot of ways we can go about this. We'll go over some of these, but I really think we should focus our attention on regression. Yeah, there you go, right there, regression analysis. But all right now, why don't we knock it off until let's say 5 of 9. When we get back, we'll at least take a peek at this. Okay, so I'll pause the recording so we don't have a lot of wasted space. All right, good. Okay. So anyway, all right. So I just want to briefly start this chapter, not get too far into it because we'll be doing this next week. So I'd really like to use Excel to illustrate a lot of these examples here. So we'll do some of that next time. But what exactly is happening in this chapter? Well, they want to explain, first of all, why would you forecast exchange rates in the first place? Now, obviously, businesses who are engaged in trade will want to understand what is likely to happen to exchange rates in the future because, of course, it affects their profitability. So it also affects their hedging strategy if they have different outlooks on what's likely to happen to exchange rates in the future. So they would like to at least have some idea of what to expect in the future. And so this is one way to do that. There's different ways we can, of course, forecast anything, much less exchange rates. So we're going to look at a few of the more widely used ones. And then we also want to understand how we can tell how well the forecasts worked out. And also they do explain why our forecasts are often wrong, but wrong could mean a lot of things. Maybe we're off by a few percent, maybe we're off by a lot. Just like if you saw before the Big Mac index, you notice how um, those percentages by which it was off was quite high. So so we have to understand how much uncertainty there's associated with these exchange rate forecasts. So now, of course, this is very important for hedging purposes. It helps a firm decide how much hedging to undertake if they have some idea of what's likely to happen to exchange rates in the near future. And they may also help them decide where to invest their funds. If you have a multinational corporation, you may have bank accounts in many different countries, and you may want to decide where to hold your funds at different points in time. And then finally, this last one, capital budgeting is the process by which corporations decide how to invest their money in things like, whether we should buy more buildings, whether we should buy more computer equipment, whether we should hire more people. In other words, these are long-term decisions about the future of the company. And these are really critically important to the survival of any company to do this correctly. So if let's say Starbucks is thinking about expanding and opening up a new branch, let's say in Berlin, or a new store in Berlin, I should say, that would be a capital budgeting decision. They have to take a lot of factors into account, but among them would be the strength of the euro versus the dollar, because it might be a good idea, but it may be that the strength of the euro could wipe out all of Starbucks profits if they're not careful. So capital budgeting is already a very challenging process rather. So when we take into account foreign exchange risk, that really makes things even more complicated. And therefore, that's one of the reasons why it's awfully important to have a feel for where exchange rates are heading in the future. Yeah, I mean, and we also have to make decisions about whether we should bring funds back home from our foreign subsidiaries, whether we should reinvest in the foreign subsidiaries, or maybe invest those funds back in the United States. And a lot of that will ultimately depend on the strength of the dollar. Also, financing decisions. Multinationals have to raise money like any other corporation. And if they're going to issue bonds, they could potentially issue those bonds in many different countries. And so they have to make decisions about where they should issue those bonds, again, depending on the cost that would result from different exchange rates. So yeah, so they're trying to tie this together for us so you can see among the many motivations for forecasting exchange rates is to decide whether or not or how much to hedge our foreign cash flows, whether to invest in foreign projects, whether or not our foreign subsidiaries should send their earnings back to the United States. And then down here at the bottom, whether or not we should borrow in the United States or in foreign countries. So the ones on top are impacting on our cash flows. The one in the bottom is impacting on our cost of capital. All these factors ultimately determine the value of the firm. So this is an important idea. Now, here's the four basic techniques we want to consider: technical forecasting, fundamental, market-based, and mixed. Now, technical forecasting is a very interesting technique. because what you're effectively doing there is you're basically saying whatever's happened in the past, we expect that to continue happening in the future. So with technical forecasting, let me just jump ahead a little bit here. First to the process of forecasting. Um, and then this applies to all assets in the economy, but here it's specifically about an exchange rate. Um, the value of a currency based entirely on its past history. Okay, so in other words, imagine we're trying to forecast the dollar pound exchange rate, and we go to Fred and we look up the last 10 years worth of dollar pound exchange rates, and it ends up looking something like this. So basically, a technical analyst would look at this curve and say, well, listen, based on what I'm seeing here, I expect that the exchange rate next year might look something like this. Okay, I'm using just the price history to come up with a forecast for the future. Nothing about the price history. No other factors are being considered. Now, of course, there's many different ways of doing that, and that's the tricky part. Technical analysis has a lot of different, let's say, approaches that you could possibly take. And you might, for example, look at the peaks. You might look at the troughs. Like you might try a different approach by simply comparing these to each other. There's all kinds of techniques. If you're interested in this stuff, there actually is an organization. Oh, I forgot what it's called. Yeah, I guess that's it. Oh, CMT. I think that's the one. There's actually an exam you can take, the Chartered Market Technician. I knew it. This is sponsored by the CMT Association. In other words, what they're basically saying here is, listen, if you are a technical analyst who forecasts into the future based on technical analysis, a lot of these guys are doing stocks, by the way. It's not just currencies, stocks. This is a big deal in the stock markets. You're trying to forecast um, stock prices in the future using technical analysis. But it's a pretty deep, intensive area of study. And they're explaining as it's a methodology that evaluates financial markets by analyzing statistical patterns in market data such as price movement, volume, and momentum to help forecast potential behavior and make informed decisions. Now, the thing is about this is that a lot of people take it very seriously and a lot of people don't take it seriously at all. It doesn't seem to be possible to prove that this is better than any other technique out there. But let's see if I can find an example of how that would work. Um, all right, let's see if we can find some graphs. Oh, for God's sake, I thought they were going to show us. Maybe not. Hmm. I think the problem is these are all ads. Yeah, I think they are. Oh, wait a minute. Now, I don't know what these little dials are supposed to be. I wanted to see the actual graphs. I mean, these are they're using techniques called oscillators and moving averages. And moving averages where you basically take the average of a variable over different points in time and you average them out, depending on what technique it is. Um, but I was hoping to show you a graph. Uh, Maybe this is a good one. Yeah. So you see what they're doing here is they're taking the actual price data and they're superimposing these different curves so you can see where the numbers are going. And there's so many different ways that we could do this. For example, look what they've done. They're taking the actual data, they're looking at different peaks and troughs, and they're connecting them somehow. I don't completely understand what they're doing here, but none of this analysis is even considering things like the state of the economy or Apple's earnings or things like that. It's 100% based on past prices for Apple stock. Nothing else is being considered. Now, some would argue that that's a waste of time because what's happened in the past is, done. It's done. It's over with. It does not continue to influence stock prices in the future. And others would say this is the most important way to forecast stocks or currencies, as the case may be. But there's all kinds of techniques. Like here's these they're trying to show you how you would take this time series and forecast it in the future. But and some of these graphs are kind of nice, but the thing is, what they ultimately all depend on is the assumption that the past will be repeated into the future. That's kind of a big deal of all different technical analysis methodologies based on the assumption that the past will be repeated in the future. All right. So in other words, that is your best way of analyzing data like this. You're saying, well, what has happened before will happen again. And so we just want to point out to where it's going based on its past history. Now, it turns out, and this is exactly what it's going to build up to, it actually can work very well for short periods of time. And here's why, because what often happens in different types of markets is that in short periods of time, they can be heavily driven by market psychology. So, for example, suppose that there is political turmoil in the UK and the pound starts to depreciate. Let's say there's rumors that the prime minister will step down and they have to have new elections or something like that. So the pound depreciates. Within the same trading day, that kind of negative sentiment will probably continue. And so what you often find is that within that same day, um, let's see, and I know this from people who actually have traded foreign exchange for a living. It'll have its ups and downs, but because everybody's so excited, that trend will probably continue for at least the rest of the day. Now, tomorrow is a different day. New information may come along and that might change everything. But within this time frame, let's say this is 4 p.m. and this is 5 p.m. You may well want to join the trend and sell the pound with everybody else because the trend is likely to continue at least for the rest of the afternoon until maybe tomorrow everybody wakes up and they realize that they've oversold the pound. So during the same few hours where everybody's getting concerned, then you know what? There's a very high chance that this trend will continue, whether it makes sense or not. That's just the way it is. People are selling the pound, they're getting nervous, they're all following each other off the same cliff. And so by the time the day's over, the pound will have fallen quite a bit. Um, So this brings up, this is something, again, one of my friends who trades or has traded foreign exchange told me the saying among the traders, the trend is your friend. Okay. But of course, now again, this really only realistically applies for short periods of time, meaning to realistically within the same trading day. Um, it may work well in one period, but not another. Maybe the same exact strategy might lose you money next year when things are very different. And if you believe that the markets are efficient, then this kind of thing really shouldn't work, except for luck. I mean, if you do make money like this, people who think that the markets are efficient would say that, you know what, you just got lucky. It cuts just as easily going back up again. So, it's hard. You're never going to be able to prove or disprove whether or not this is actually working because you can't tell, like, well, why did it go down? It went down. We know that, but we can't be sure why. So this is the type of thing. This is all called technical analysis. And for short periods of time, it might work just fine, but for longer periods of time, you can't expect it to work because there's too much other information that's affecting the values of assets, including exchange rates. So over a longer period of time, fundamental analysis is likely to be more useful. This is based on economic variables, such as GDP growth, inflation, unemployment, interest rates, trade deficits, et cetera, et cetera. So here, what you're actually doing is you're not just forecasting a trend into the future. What you're actually doing here is this requires the use of a model of some type, which attempts to explain how these factors affect a variable such as a currency and how strong the effect is. So these types of models are often implemented using regression analysis. Because with a regression model, you are actually trying to explain not just the future direction of a variable, but where did that come from? You're trying to isolate the impact of the different independent variables to determine what's happening to, let's say, the dollar pound exchange rate. So this is a very popular choice for developing these fundamental models. And if you find that your results work well, it should continue to work well into the future, assuming nothing major changes. Whereas with the technical analysis, it might be successful for very short periods of time, but it's not likely to be very helpful over even just a few days or a week because you're not really attempting to explain what's happening where here you are. So this is a challenging approach, but it's likely to be successful over longer periods of time. So that's just a very brief look at fundamental analysis. Let's see, what else did they ask us to look at? Wait a minute, hold on. Here it is. Then we've got market-based and mixed. So then when that's all done, what we're going to do is consider how to determine how well our forecast is working. So in other words, let's say that you have two different forecasting approaches and you want to know which one works better. Okay. So let me just make some examples up here. Suppose you have let's say that's the dollar pound exchange rate. And we have two different forecasting techniques. I'll draw them in red, let's say, two different colors. There's green. And then let's say red is the other one. So the question is, how do you know which one did a better job? Well, you could see that red didn't stay particularly close to black until the very end, whereas green stayed pretty close, but at the end it deviated to a certain degree. So we want to introduce some concepts or some techniques that help us determine how well a forecasting technique performed so we can compare them to each other before we decide which one to use. Now, none of them will be perfect, of course, but we want to minimize the amount of error that's involved so we can have some confidence in our results. All right. So anyway, like I said, I think what I'd like to be able to do is find some data. I got some data in here too, but I want to be able to do something like this. Have enough data so we can actually do some regression analysis. I hope that I can find exchange rate data online. It used to be very easy. I know Fred has some exchange rate data, so maybe I'll find it there. They also have all the economic variables that we might need. So we might be able to put together a forecasting model that shows how the dollar pound exchange rate responds to changes in, let's say, interest rates or inflation rates. So I'll work on that between now and next Tuesday, when, by the way, we'll be meeting in person. So if we're going to do regression analysis in the classroom, you really should try to bring your laptops along so that we can all do this together in Excel. Okay. But I'll remind you again during the week. I'll send you out emails and say, by the way, don't forget, we're going to be in room 135 and we're going to do some regression analysis. All right. So I guess in the meantime, I guess that'll have to do for now. I think we've gotten as far as we can get without, introducing our regression analysis. That we can save for next time. All right. So in the meantime, I guess I'll see you all next week in the classroom, and then we'll carry on with our discussion about forecasting and regression analysis. All right, so I guess I'll see you all then.
Thank
Thank you,
you. Good
Professor. I
night.
have a question.
Yes, go ahead.
Is the paper, are we gonna do regression analysis in the paper, or is it gonna
If
be
you
like,
want to. Oh, sure,
okay,
that's up to you. If you do regression analysis with actual data, that's fantastic. Absolutely.
is there a certain format for the paper?
Well, what you would do is you would start out by explaining what it is you hope to accomplish with your regression analysis. And then you explain the background to what you're trying to do. And then you tell us where the data came from. And then you run the models, print the results, you explain what you found, and then you draw conclusions from it.
Okay. Okay.
So yeah, I'm glad to hear that. If you want to do that, that's fantastic.
Okay.
All right, anyone else? All right, then I'll see you all next time.
See you.
All right, good night.